Hey, what's going on, everyone? Welcome back to the channel. I'm Alex Morgan, and if you're new here, this is the place where we break down markets, precious metals, and macro trends in a way that actually makes sense. No fluff, no hype, just real data, real analysis, and real talk about where your money might be headed. Before we dive in, if you haven't already, hit that subscribe button right now and ring the notification bell so you never miss a video. And if you find this valuable, drop a like. It genuinely helps this channel grow and lets me keep making content like this for you. All right, let's get into it. Today we are talking about silver. And I mean really talking about it, because 2026 has already delivered one of the most insane, jaw-dropping, gut-wrenching stories in the history of precious metals markets. If you haven't been watching closely, you might have missed a run that made Bitcoin's moves look calm. And right now, as of this recording on February 23, 2026, silver is sitting around $87 per ounce. And that number alone tells only a fraction of the story. So let's rewind. Let's go back to the beginning of this year, because understanding where silver is today requires understanding what just happened, and what it means for the next several weeks through April. To start, you have to appreciate the scale of what silver did in January 2026. On January 1st, silver opened the year near $70 per ounce. That was already elevated compared to where it had been a year prior. But in the first 4 weeks of the year, something almost unprecedented happened. Silver surged roughly 60% in under a month, rocketing all the way to an all-time nominal high of approximately $121 per ounce on January 29th. Let that sink in for a second. $121 per ounce. A metal that many people hadn't thought about since the pandemic. A metal that spent most of the early 2020s bouncing between $20 and $30. It was trading above $120. What drove that? A cocktail of factors that, when combined, created a perfect storm. First, industrial demand has been structurally elevated for years because of the green energy transition. Solar panels require enormous amounts of silver, and global solar capacity has been expanding at record rates. That's not a short-term story. That's a decade-long structural shift in demand. At the same time, supply was already constrained. The world's biggest silver-producing nations, Mexico, Peru, China, were not dramatically ramping up output to meet the surge. Second, the macroeconomic environment was tailor-made for precious metals. Inflation concerns hadn't fully evaporated. The Federal Reserve had been cutting rates through 2025, and there was growing uncertainty about where monetary policy was headed in 2026. The US dollar had been under pressure. When the dollar weakens, commodities priced in dollars, like silver, tend to rise. Geopolitical tensions, including renewed concerns in the Middle East involving Iran, were also pushing investors towards safe haven assets. And when you have both safe haven demand and industrial demand colliding at the same time, you get a price surge that doesn't follow normal rules. Third, and this is the part that gets controversial, there was speculative activity. Significant speculative activity. Multiple analysts used the word broken to describe silver's price action during the January rally. MKS PAMP's market strategists pointed to what they called unheard-of volatility, driven less by physical fundamentals than by wild liquidity flows. Galena Asset Management describes silver as behaving in ways that fundamentals alone simply couldn't explain. And JP Morgan's own analysts warned, even while silver was climbing, that they were seeing signs of meme trader behavior, the kind of speculative mania they had previously observed in assets like GameStop and meme stocks. They put a downside target of $50 on silver, even as it was above 110, which many dismissed at the time as absurd. Then came January 29th and 30th, and everything changed. The sell-off that hit silver on January 30th and 31st, 2026, is already being called one of the most severe single-day collapses in precious metals history. On Thursday the 29th, silver hit its all-time high near $121 per ounce. Less than 30 hours later, by Friday afternoon, silver had plunged to an intraday low just below $75, a 38% decline, in under 2 days. Silver's worst single-session drop in percentage terms since 1980. What triggered it? A combination of things hit simultaneously, and that's what made the crash so violent. The single biggest catalyst was a news announcement. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is widely known as a monetary hawk. He has a history of warning about inflation risks and advocating for a smaller Fed balance sheet. The moment markets absorbed that news, everything that had fueled the silver rally, expectations for continued rate cuts, dollar weakness, easy monetary conditions, began to reprice instantly. U.S. Treasury yields spiked, the dollar strengthened sharply, and gold and silver sold off hard. But the announcement alone doesn't fully explain a 30+% decline in silver versus a roughly 12% decline in gold on the same day. The additional amplifiers were structural. The CME Group, the Chicago Mercantile Exchange, which runs the major silver futures market, had already been raising margin requirements for silver futures twice within a 4-day window in January. When margin requirements go up, traders holding leveraged positions face a binary choice: put up more cash or get liquidated. When liquidations happen at scale, selling begets more selling. It becomes a cascade. On top of that, January 31st was the final trading day of the month, a date when futures contracts roll over and institutional rebalancing happens. Options were also expiring around the same period. When you layer forced margin liquidations on top of month-end mechanics and options expiration, the selling pressure becomes mechanically amplified far beyond what any single piece of news would normally cause. The Shanghai Futures Exchange compounded the pressure from the other side. Chinese regulators had been raising silver margin requirements and reducing position limits for speculative traders throughout January. They barred 16 clients from opening new positions. When two of the world's largest futures exchanges tighten simultaneously, while a hawkish Fed narrative emerges, leveraged silver positions simply implode. By the time the dust settled at the end of January, silver had gone from $121 at its peak to closing the week around $85. Gold, which had briefly touched $5,600 per ounce, finished the month near $4,894. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, exploded from the mid-40s to nearly 57 in a matter of days. That ratio blowout tells you that silver got hit far harder than gold, which is consistent with what we always see in sharp de-risking events. Silver, with its smaller and more speculative market, always takes the biggest hits on the way down. So where does that leave us today, in late February 2026? Let's look at the actual data. As of February 23, 2026, silver spot price is trading around $87 per ounce, having recovered significantly from the post-crash lows. To give you a timeline of what happened between the crash and now, on February 2nd, silver was around $81 to $82 per ounce. On February 5th, it dipped to about $77. February 10th saw it slide toward $82 again, before briefly dropping below that. February 11th, it spiked all the way back to $84.72 in a single session, gaining nearly 5% in one day. By February 17th, it pulled back toward $74. Then, on February 19th, it was at $78, and by February 20th, it was back up to $80.46. And today, as I'm recording, we're sitting closer to $87 to $88. What you're seeing in that price action is textbook post-crash volatility. The market is trying to find a new equilibrium. There's no straight line after a crash of this magnitude. You get violent bounces, sharp pullbacks, and then gradually a range-establishing process begins. Silver is currently doing exactly that. The question everyone is asking right now is the recovery real? Or is this just a dead cat bounce before silver falls further, potentially back toward $50 as some analysts were predicting? Here's how I think about it. There are two competing forces at work right now. On one side, you have the structural bulls. The physical silver market is still showing signs of genuine tightness. In the days after the futures market crashed, something unusual happened. The spread between futures prices and physical spot prices widened dramatically. While COMEX futures were trading in the 60s and 70s during the worst of the crash, the Shanghai Metals Exchange was still offering physical silver north of $90 to $110 per ounce. The Shenzhen Shuibei gold market, one of the largest physical markets in China, was selling physical silver at prices well above what the futures market was showing. That divergence tells you something important. The paper market crashed because of forced liquidations and speculative deleveraging, but actual physical demand never disappeared. People who wanted real, deliverable silver were still paying a significant premium to get it. Silver's industrial demand story has not changed. Solar installations aren't being canceled. The electrification of transportation hasn't reversed. The structural supply deficit that most analysts identified heading into 2026 is still there. The Silver Institute's annual demand forecast had pointed to consecutive years of above-ground supply deficits, and nothing in the crash changed those underlying numbers. Safe haven demand also remains relevant. The Iran nuclear tensions that have been escalating in February 2026 are still very much present. Goldman Sachs reiterated its year-end gold target of $5,400 per ounce, even after the January crash. And gold, currently trading around $5,000, provides a supportive floor narrative for silver as well. The gold-to-silver ratio at roughly 57-1 is still historically elevated, meaning silver is relatively cheap compared to gold by historical standards. In bull markets for precious metals, that ratio tends to compress, which implies silver has more upside relative to gold. On the other side of the argument, the bears have valid points too. The Kevin Warsh Fed narrative hasn't gone away. If he is confirmed and he pursues the hawkish policy path that markets expect, that's a headwind for all non-yielding assets, including silver. Right now, the CME FedWatch tool shows markets pricing in roughly 60 basis points of Fed rate cuts by year-end 2026, with the first cut not expected until June. That's a much more modest easing cycle than what traders had been assuming during the January rally, and that matters. Every basis point of rate cut expectations that gets priced out is a marginal headwind for silver. The dollar, while not rampaging higher, has shown resilience. A strong dollar is structurally negative for silver, and the speculative positioning in silver futures, even after the crash, could still be longer than what the market can sustainably support at current prices. When speculative longs remain elevated even after a major correction, there's always the risk of additional unwinding. JP Morgan's $50 target hasn't officially been walked back. Their argument was essentially that the entire move above $80 was speculative excess built on a narrow foundation of genuine industrial demand, and that the mean reversion could be severe. Whether that's the right call is debatable, but it can't be dismissed. So what happens next? Let me walk through the key scenarios and the data points that I'm watching between now and April 2026. The most likely scenario, based on the current technical setup and the macro backdrop, is that silver continues to consolidate in a range between roughly $75 and $100 per ounce for the next 6 to 10 weeks. The crash established a new lower range, and the recovery bounce has already taken silver back into the 80s and now pushing toward $90. The next test will be whether silver can sustain above $90 and push toward the psychological $100 level, or whether it fails there and pulls back toward $75 again. The $100 level is important for a specific reason. It's not just a round number. It's the level where many speculative traders who bought above $100 during the January rally are sitting at losses. If silver approaches $100, some of those investors will use the opportunity to exit at break-even, creating what traders call overhead resistance. That selling pressure at $100 is real and has to be cleared for silver to make a sustained move back toward its all-time highs. A bullish scenario, one that I'd assign maybe a 30% probability, would see silver break cleanly above $100 before April, driven by a combination of renewed dollar weakness, a geopolitical escalation involving Iran that pushes safe haven flows into metals, or a surprise dovish shift in Fed communication. If silver breaks $100 with conviction, the next target would be $110 to $115, which would put it in striking distance of its all-time high. Mining stocks like Hecla Mining, Pan American Silver, and Coeur Mining would likely surge in that scenario, as mining equities have high operational leverage to silver prices. A bearish scenario, maybe 25% probability, would be a breakdown below $75, back toward the $60 to $65 range. This would likely require a combination of a further hawkish shift in Fed expectations, dollar strength, and continued speculative deleveraging in the futures market. In this scenario, JP Morgan's $50 target starts to look less like a bear case and more like a genuine possibility, though I think getting all the way to $50 would require a significant deterioration in global growth expectations that would hurt industrial demand as well. The base case, roughly 45% probability, is the range-bound scenario I described first. Silver oscillates between $75 and $100, with lots of volatility, as the market waits for clearer signals on Fed policy, geopolitical developments, and physical demand trends heading into Q2. There's a wild card I want to highlight. Multiple analysts and market observers have pointed to what appears to be an unusual divergence between the COMEX paper futures market and the physical silver market. Some voices, including commentary from the SLV investor community and precious metals dealers, have raised the possibility that the magnitude of the January crash was partly engineered, or at least exacerbated by large institutional short positions held by major banks, including JP Morgan, UBS, and Deutsche Bank. The argument is that with hundreds of billions of dollars in short positions at risk of being squeezed as silver climbed toward $120, the margin hikes from CME and the sharp hawkish news catalysts were a convenient escape valve for those short sellers. Whether you believe that's deliberate manipulation or simply how markets mechanically function under stress, the fact remains that if those short positions have now been reduced and the fundamentals are still intact, the next price surge when it comes could be even sharper than January's. The market remembers what happened, and any new bull run would come with traders already positioned for volatility. What does all of this mean for your portfolio and for the stock market more broadly? Silver's behavior has implications beyond just the metal itself. The wild swings we've seen are part of a broader story about the health of financial markets right now. The January crash in silver happened simultaneously with a broader risk-off move that hit stocks hard. The S&P 500 reacted sharply to the Warsh nomination and to the broader hawkish repricing of rate expectations. If silver stabilizes and recovers toward $100, that would typically be consistent with a broader risk-on environment, a signal that inflation expectations are re-anchoring, that geopolitical fears are driving safe haven demand but not crisis-level panic, and that the economy is still absorbing rate pressures without collapsing. If silver breaks down toward $60, that would be a much darker signal. A commodity that has industrial demand as a core driver doesn't typically crash unless industrial activity is expected to weaken. A silver collapse toward $50 or $60 would be consistent with a meaningful slowdown in manufacturing, technology, and green energy investment, all of which would have significant negative implications for equity markets, particularly technology and industrials. The gold-to-silver ratio is something I'd encourage you to watch closely. Right now, it's around 57-1. If it starts moving back toward 50 or below, that's a sign that silver is outperforming gold, historically a bullish signal for risk appetite generally. If it blows out above 70, that's a warning sign that something more serious is developing in markets. On the Fed side, the next major data points before April include the January jobs report, which was delayed but is now expected, and the January CPI and PCE inflation readings. If those come in softer than expected, rate cut expectations will move forward, and both gold and silver will likely catch a bid. If inflation remains sticky, the hawkish narrative wins and metals stay under pressure. For stock market direction between now and April 2026, I'm watching three things: whether silver can hold above $75, whether the dollar index stays below 105, and whether 10-year Treasury yields remain below 4.75%. If all three conditions are met, I believe the equity market, particularly the S&P 500, has room to recover toward the January highs before April. If any of those levels break in the wrong direction, expect further equity market weakness as the market reprices for a tighter for longer environment. Let me leave you with this. The silver story in 2026 is not over. It's barely begun. What we saw in January was extraordinary, a 264% gain from a year ago, a new all-time high, and then one of the most violent crashes in the metal's history, all in the span of a single month. But the fundamentals that drove silver higher have not gone away. The structural supply deficit is still there. Industrial demand from solar, electronics, and green tech is still growing. Geopolitical uncertainty is still elevated. And physical silver demand, the kind that shows up in actual vaults and coin dealers, remains strong even during the futures market chaos. The market is now in a period of reset and recalibration. Speculative excess has been purged, at least partially. The weak hands that bought at $110 and $120 have either been liquidated or are sitting on losses waiting for a chance to exit. That's actually the foundation from which sustainable moves are built. Whether silver reaches back to $100 or falls towards $60 before April depends largely on decisions being made right now in Washington, at the Federal Reserve, and in geopolitical hotspots around the world. None of us can control those outcomes. What we can do is watch the data, understand the structure of the market, and position accordingly with appropriate risk management. I'll be posting updates on silver throughout February and March, so make sure you are subscribed and have the bell notification on. If you want to go deeper on any of the topics we covered today, whether it's the gold to silver ratio, the Fed's rate path, or the specific mining stocks worth watching, let me know in the comments and I'll make dedicated videos on those. As always, nothing in this video is financial advice. I'm not your financial advisor. Do your own research, understand your risk tolerance, and make decisions that are right for your individual situation. This is purely educational content to help you understand what's happening in markets. Thank you so much for watching. I'm Alex Morgan. If you got value from this video, subscribe right now if you haven't already. The button is right there. Leave a like, drop a comment, and I'll see you in the next one. Take care.